Hi, this is Amir from FinQuest Institute. In this video, we'll introduce ourselves to the reforms in global interest rate benchmarks framework. So before we get on to the reforms process, let's try to understand what the current benchmarks are. So for that, we need to understand a brief background around Libor. So Libor is a short form for London Interbank Offered Rate. So Libor has been around for a very long time. So close to 35 to 40 years, Libor has been a benchmark which the financial market has been using for various transactions. So be it products on the cash markets or on the derivatives markets. So on the cash market side, we could have, let's say, a floating rate bond. So the coupon of that bond could be linked to Libor. And for derivatives, let's say I might have an interest rate swap on which the floating leg of the interest rate swap could be linked to Libor. So these are just a couple of examples. You have multiple such products in the market which are dependent on Libor as the benchmark. And Libor is ingrained into the financial system because since it has been around for such a long time and the market has adopted that Libor to a significant extent. So banks and financial institutions have a large portion of their portfolio which is linked to Libor. So Libor is a rate which is quoted for different currencies. So it's not just a single currency quote. So if we focus on the five major currencies, so we'll have Libor which is quoted for USD, for Euros, for GBP, for CHF and JPY. So I have listed these five because these five are the five major currency areas as we call them. So to understand the process of Libor, let's focus on, let's say I'm looking only at USD Libor. And for each of these currencies, you'll have Libors which are quoted for different tenors. So you'll have a Libor which is for 1 month, 2 month, 3 months, 6 month, right up till 1 year. So let's focus on, let's say USD 3-month Libor. So who publishes Libor? So there is an organization called as ICE, which we call as Intercontinental Exchange, which publishes Libor. So to understand the process behind this, so for any rate like for the Libor for any particular currency to be quoted, we require quotations coming in from what we call as panel banks. So panel banks are large global banks who submit their quotations of Libor to ICE. So ICE, as I mentioned, is the authority which is going to publish the rates which will be consumed by the market. So every day, banks are going to submit their estimates of what the Libor is going to be on that particular day. So each bank in this panel bank, so these are large global banks and which are extremely active in the global financial markets. So they are going to submit their estimates of Libor for that particular day. So these submissions are received by ICE. So ICE, after removing the outliers from the quotations received, is going to publish what you call as the Libor for that day. So ICE is going to publish a Libor for every maturity. So there are certain standard maturities which are defined and ICE is going to publish Libor for each of them. So the point in question is USD 3-month Libor. So ICE is going to publish the USD 3-month Libor for that day. So let's say ICE has received quotations from all the banks and today morning it has published the USD 3-month Libor quote. So this is also what you call as the Libor fixing. And this Libor fixing can be for today, let's say day T. So this fixing is as of today. Now come tomorrow, these panel banks will again submit a new set of Libor quotes and they will be submitted to ICE and ICE will again compile them, remove outliers and publish a new Libor fixing tomorrow. So tomorrow morning, a new USD 3-month Libor will be published by ICE. So you'll have a new Libor fixing, let's say at time point T plus 1, because assuming we are at time point T today, so T plus 1 will be naturally tomorrow. So likewise, every day ICE is going to receive these kind of quotations from these panel banks and it is going to publish the Libor fixings for that particular day. So here we have spoken of a simple example of just USD 3-month Libor. But that way you'll have the Libors which are published for other other maturities and also for other currencies. So this is something which will happen on a daily basis. So let's understand the reason behind the benchmarks process which began a few years back. So the reason behind that was a LIBOR rigging scandal which had rocked the financial market around 2013 2014. So so as a part of this scandal, what had happened was a few traders from these panel banks had colluded, and they used to quote the LIBOR rates in such a way that they were favorable only for them. So they weren't really fair market rates. They used to rig the rates in such a way that they were beneficial for those set of traders. Of course, I mean, all of these global banks did have certain checks and balances to ensure that such things don't happen. But again, this was a fraud which was happening at a few banks, which resulted in a rigging scandal which came to light. And this shook the financial market. So, post that, a lot of regulatory actions began against many panel banks and against respective traders as well. So subsequently, various regulatory authorities around the globe also got thinking that they need to have something which is there, which is more robust than LIBOR, something which cannot be rigged. So that's when the process of reform began. So it required close to 6 to 7 years of thorough analysis before new benchmarks were thought of, and we'll talk about the new benchmarks in a bit. But so it was since this rigging scandal that the market began to think that they need to move on to something which is more robust. They can't really depend on LIBOR because, as we say, so as the saying goes, history repeats. So something which has happened in the past always has a potential to happen in the future. So that is something which the market doesn't want. So that's why this reforms process was proposed. Then the importance of LIBOR we briefly discussed. Now LIBOR is important because of the way in which it is so deeply ingrained in the financial system. So you have trillions of dollars of worth of notional of financial products which are linked to LIBOR. That's why it is such a significant rate. And you can imagine that if you have a rigged rate, and if that is being used as a reference for such a large portfolio position globally, then what would be the global impact? So regulators and market participants realize that, and that's why there is a push towards these new benchmarks. So to understand, so before we understand the benchmarks, let's talk about a few drawbacks of LIBOR which led to the rigging scandal. So firstly, LIBOR rates are something which are quoted by banks. That is, these may be non-traded rates. So when I say non-traded rates, they are also non-binding rates. So non-traded and non-binding. So I think these are the 2 points which were considered by the market participants as well as regulators when they started looking at the weaknesses of LIBOR. So we know that panel banks submit rates to ICE on a daily basis. So prior to ICE, it was the British Bankers Association. So BBA was handling the LIBOR publication right until 2014. But when the LIBOR rigging scandal shook the market, then FCA so FCA basically decided that BBA should not be entrusted that responsibility anymore, and then subsequently through a tender process, ICE was the organization which was appointed and which was given the responsibility to publish the LIBORs. Of course, there were few additional checks and balances which were introduced post the rigging scandal to ensure that those things do not happen. So ICE is abiding by those rules and guidelines to ensure that LIBORs are published in a streamlined fashion. But coming back to the 2 points which we say are primary weaknesses around LIBOR. So firstly, they are non-traded quotes because these are quotations which are received by banks. Now, these may not necessarily be the rates at which those panel banks are going to transact with each other. So a live trade may not happen on these rates. So that's why we call it as a non-traded rate. Now, something which is non-traded has a potential to get rigged. So that's what precisely happened for LIBORs. And next, these are non-binding. So panel banks may submit these rates to ICE. However, it's not binding on these panel banks to actually transact on these rates. Now, there's no guideline which says that they have to transact on these rates which they quote to the ICE. So that's why these become non-binding in nature. So these two were primary weaknesses around LIBOR benchmarks, and this is the reason why the LIBOR rigging scandal could happen, because something which is not traded can be rigged. So that's where the new benchmarks come into play, and that is what a transition. So that's the global transition which we are talking about. Something which is going to happen by the end of December 2021. So 31st December 2021 would be the last date at which LIBOR is going to be published for majority of the currencies. Only a few tenors around USD LIBOR will continue to be published right until July 2023. So to introduce ourselves to the new benchmarks, so these are the new benchmarks which are being thought of. So let's talk of, let's say, three major ones. And there are or maybe the five major ones as we mentioned earlier. So these are my currencies. So for USD we have SOFR, SOFR. For Euro we have Ester. For GBP we have Sonia. We have a Saron for CHF. We have a Tona for JPY. So these are the proposed new benchmarks which financial markets are going to use going ahead. So these now the advantage of these are overnight rates, and these are actually traded rates. So something which has been traded cannot be rigged. So that makes the overall system fail safe, because once an actual trade has happened on a certain rate, then no one can go back and rig that rate because the trade has already happened. So that's the advantage of these new benchmarks. So these are all overnight benchmarks, and which the market is proposing to use. And these rates come from the money market transactions which happen in the respective currencies. Now, the main difference between LIBOR and these benchmarks is LIBOR was a forward looking measure, whereas all of these new benchmarks, these are backward looking measures. So, what do we mean by that? So when we have a LIBOR, then we had all the LIBOR forward curves which we could actually build using the LIBOR swap curves. So for any LIBOR swap curve which you have, we could bootstrap that and we could arrive at the implied forward rates. So that way, at the start of the period, we would know what is the LIBOR rate to be used for that particular period. However, for the new benchmarks which we are talking about here, these are backward looking, because since these are actually traded rates, these rates will only be available on the next working day. So let's say today is a Tuesday. Then the rates as of Monday evening will be available on Tuesday morning for consumption. So Bloomberg would be publishing these rates and they can be consumed by the market for their calculation purposes. So that's why we say that is a backward looking measure. That is, we have to wait until next day in order to know what the rate is to be used as of that day, which is nothing but the closing rate as of the previous day. So this is the main difference between the LIBOR and these new benchmarks. Now, the role of regulators and standard setting organizations. So regulators and standard setting bodies like, let's say, IOSCO, they are playing a very active role in the overall benchmarks transition, and they are working closely with market participants to ensure that the overall process moves in a very, very streamlined and a smooth manner. That is because this is a major shift which is happening in the global market. Because imagine that we are replacing an entire set framework by something which is new. Now, again, this is not an overnight activity. It is going to take time. So, regulators and market also knows that. So, they are taking their efforts to ensure that gradually liquidity also builds up on these benchmarks. Because currently LIBORs are very, very liquid. So, you have a lot of trades which happen on LIBOR, and that's naturally because the market has adopted LIBOR for close to 3 to 3.5 decades now. Now, these new benchmarks are also seeing a gradual upstick in the overall liquidity which is happening on these trades. So most banks and financial institutions, for all the new transactions which they are doing it based on these new benchmarks. So gradually liquidity is building up. So that's the global push. So once you have a sufficient amount of liquidity on these new benchmarks, then market will find it far easier to use these benchmarks going ahead. So on a global scale, there is a large scale effort going on around this, and most banks are advising their customers that whatever new contracts which they do, they are going to be using these new benchmarks. Also, at the same time, there are certain fallbacks which are defined as well. So they may want to probably renegotiate a few contracts which are already done with their clients at an earlier point in time. So they may replace those contracts, and those could be and those will transition onto these new benchmarks, and then they'll continue to be held onto the bank's books. So that is also a global exercise which is underway. So this overall reforms process presents a lot of challenges and opportunities. So I would say challenges because globally, since we have used LIBOR for such a long time, and it is such a popular and a deeply ingrained rate within the financial system. Simply uprooting that overnight is simply not possible. So this is going to be a gradual process. So that's what we are seeing. And gradually, volumes are building up around the overnight rates, and we hope that by the end of December 2021, this and an ample amount of liquidity builds up. So that's why it will make it easier for market participants to transition onto all of these new benchmarks. So banks and financial institutions are also doing their bit. They are not really so they are also advising their clients to not really do new trades on these older LIBORs, because LIBOR is going to cease to exist after that. So, and also from a challenges perspective, you already have the overall bank's enterprise risk systems which are tuned to work with LIBORs. So, be it your derivatives, whereby you have all these interest rate swap curves which are configured into, let's say, your enterprise risk system. Now, these systems have a ready calculator which is simply going to accept these rates and is going to provide the relevant zero rates and implied forward rates which will be used by the financial portfolio of the bank. Similarly, even the loan portfolio may be looking at these rates because many of the loans may be floating rate in nature. So there is a transition which is going to happen. So your earlier systems will have to get reformed as well, because because now you're moving from a forward-looking estimate onto a backward-looking measure. So especially your loan book, because banks have a lot of loans which are marked against LIBOR. So there is a global effort to get the banking systems ready. So most of the enterprise risk systems are going to provide what we call as the all-in rate for each of these currencies. So all-in rate is something which you can imagine as an effective rate which can be used for your loan calculations or any kind of computations on your loan books. Similarly, even there is gradual liquidity which is building up on the swaps rates as well. So as of now, we are going to rely on the backward looking measure. However, the market is still looking if there can be a forward looking estimate which may possibly come up with these new benchmarks. Now that is a challenge which only time will tell if that forward looking thing can work out. Otherwise, it will be more of the backward looking estimates which the market is anyways willing to use. Now, there are opportunities. So I would say opportunities mainly from talent acquisition for companies or from the jobs market perspective. Because we know that for whenever this kind of transition happens, so whenever such a large scale change is happening in the system, then you require financial expertise from resources. So there may be an increased demand for people who have excellent knowledge of rates modeling, or maybe who are very sound with their hands-on skills around technology implementations, or probably those who are very strong on the financial engineering or math finance side of things. So that way there are potential opportunities which may open up because of this large scale transition which is happening. And that's why I feel that there are opportunities around this reforms as well. So this video was more of a primer or a basic introduction to the overall benchmarks transition process which is happening on a global scale. In a separate video, we'll try and understand the calculation which can be done for computation of the all-in rate. So stay tuned for updates on our new videos. Thank you.